So it's 1 o'clock, so we'll get started today. My name's Dr. Will Maples with the Department of Agricultural Economics at Mississippi State University and the Mississippi State University Extension Service. And I'm joined today by Dr. Keith Cobles, the department head of the Agricultural Economics Department, and Dr. Jeff Johnson, also with the Agricultural Economics Department. And today, what we really wanted to take this webinar opportunity to do is just kind of give you an update of the row crop markets and what we kind of see going forward. We've seen a lot of, there's been a lot of change in the past month, as everybody's aware of. So we really want to take this opportunity to kind of just update you on what we see and some ideas and considerations going forward. So just kind of an overview of our webinar today. I'm going to kind of give you a brief market update here at the first. Then Dr. Johnson is going to step in and kind of talk about some farm management considerations that producers can be considering right now going forward in kind of these low price kind of times. And then Keith is going to step in and kind of talk about some policy implications that we've seen due to the circumstances of the past month and some future policy we might see going forward. So during this webinar at any time, if you have any questions, if you're on Zoom, you can enter in the chat and put in your questions at any time, and we'll be happy to answer them at the end. So getting started, just to kind of get into a market update, so from when I was giving market talks back in January and February, since then, there's really two new pieces of information that we have and could consider now that we didn't back then. And the first thing is, as everybody's aware of, is this COVID-19 virus pandemic that is currently hanging over the market. So as you can see from this graph, this is the market change since January 1st. So as of last week when I made this graph, what has been the percent change in prices of various commodities? So this thin line here is the S&P 500 index. This is an overall stock index that kind of represents the U.S. economy. From the first of the year, it's dropped off at the low point nearly 30%. It's still down about 25% from where we were when we started out this year due to the virus pandemic. Cotton has been the most affected by the virus pandemic in the market downturn. And so we can see its cotton prices are down nearly 25%. So these are just the nearby futures contract price for these commodities. Corn's down about 15%, and soybeans has been our least affected, down about 10%. But soybeans started losing some ground back before really the pandemic issues started. So going forward today, we're going to kind of discuss a little bit about the reasons for this market downturn for the various commodities and what that means going forward. And also the second piece of information we've obtained in recent days for looking outward to 2020 and 2021 is on March 31st, the USDA came out with their 2020-2021 prospective planting numbers. So the USDA surveyed producers during the first 2 weeks of March about what were their planting intentions for the upcoming year. So pretty kind of surprised a lot of people. Corn acres came in at about 97 million acres this year, up 7.5% from last year. This was pretty a substantial number above what trade estimates put it at. Cotton acres, kind of surprising to me, or suggested to remain flat this year. I thought we would see a decrease in cotton acres, but really it was only down 0.3%. Soybean acres came in at 83.5 million acres. We expected a rebound of soybean acres from the lows of last year, so they're up about 9%. Rice acres up about 11%, and peanut acres up about 6.6%. For Mississippi specifically, we're seeing a 10% increase in soybean acres for the 2020 year. This was expected. Cotton down 7%, 7.5%. Corn up 7%. It's kind of funny with your corn and cotton numbers. Last year, we planted 710,000 acres of cotton in Mississippi and 660,000 acres of corn in Mississippi. And this year, we basically just swapped those two numbers. Rice up about 30,000 acres in Mississippi to 150. And then peanuts are basically staying flat in Mississippi. So looking ahead. So kind of considering the current COVID-19 pandemic and its effects on the market and kind of these new planting numbers we have, we're going to kind of just work through each commodity for corn, cotton, and soybeans and just kind of look at how can we expect this current market year to kind of finish up and kind of look ahead to the next 2021 marketing year. So we'll start with corn and we'll discuss first out kind of how this pandemic is having an effect on the corn market. And the effect on corn is coming through ethanol, as we'll see. So currently, I think all of about 8 states in the United States have stay-at-home orders in place. I think Mississippi runs through April 20th. So what that has done to the gasoline demand in the United States, due to everybody's just not traveling right now, it has tanked gasoline demand. This is a line, so this gray line is 2020 gasoline supplied. As we can see, it has a huge decrease in supply of gasoline over the past month. And of course, as we'd expect, that has also led to less driving as fuel ethanol production is way down as well due to this less travel. So for 2020, we're down to about, it was like 680,000 barrels per day of production of ethanol. This is the lowest it's been since the early 2010. And so this is ethanol plants have kind of been in the tough times the last few years anyways, and this has not been good for corn and ethanol demand. So we're seeing decreased ethanol production. We're also seeing an increase in fuel ethanol stocks due to this, just because people aren't out moving and driving. So this is lost corn demand that will go into ethanol for us. And so this morning, so this is the corn balance sheet, and I've got 4 columns here. So these first 2 columns are for the 2019-20 crop year, and these last 2 columns are for the 2021 upcoming crop year. So this morning, the USDA came out with their latest World Agricultural Supply and Demand Estimates, or their WASDE. So that's what this second column of numbers here is. And what it's given us is really our first look at how much has corn for ethanol demand been hurt. So coming from our March number of last month, corn for ethanol is about 5.4 billion bushels of corn. This newest report dropped it to about the 5 billion 50 million bushels. So we've seen a 320 something million bushel decrease in corn demand for ethanol. And that's kind of what we expected. We knew ethanol demand would be down. So on the latest WASDE numbers, supply has not changed at all. Supply is set for the year. They did downgrade some import. They downgraded some imports, which is why my supply number here is different than last year. But on the consumption side, feed and residual picked up some of that lost corn demand from the ethanol, up a little bit. But overall, total consumption of corn demand in the 2019-20 marketing year is down. Thus, ending stocks are up a little over 2 billion. Stocks to use ratio up. And they adjusted the average farm price down for this marketing year to $3.60. So looking ahead to 2020-2021, the USDA came out with some preliminary outlook numbers in part of February at their annual outlook forum they do every year. So these are numbers that were produced before this pandemic and others' thoughts were even came into play. So while they're a little out of date, I think they give us a good start looking ahead for what we can kind of expect. So they had us pegged at 94 million acres of corn this year, which is less than the 97 million acres that we saw this come out. So we're looking at about a total production of corn for the upcoming marketing year of 15.4 billion bushels. They had ethanol consumption up a little bit, 5.4 billion, total consumption up. Thus, ending stocks, though, were going to come up just due to a higher corn production and a average farm price of $360 for the year. So this last column is just kind of my thoughts, kind of taking what the USDA was doing last year with their preliminary numbers from their Outlook Forum and kind of some of the new information we know from the current April WASDE and this kind of the effect of the virus and pandemic. So, Prospective Planting had acres at 97 million acres of corn. I think that's a little high. I think that farmers probably up in the Midwest really do want to plant corn kind of antecedently. I've heard that, they prefer growing corn up there than soybeans. But 97 million acres seems like a lot to me. So let's adjust that down to 96 million acres. Same ratio to harvested acres as the Outlook Farm. We'll keep the Outlook Farm's yield. But overall, bigger increase of production, 15.8 billion bushels of corn, increased total supply. We're also bringing in a higher beginning stocks due to our decreased ethanol demand we're seeing this year. Ethanol consumption, our main concern there is how are the ethanol plants going to be able to withstand this dramatic decrease in ethanol prices and just less demand. I think we probably are going to lose some capacity out of this, and thus I don't think we can expect as much ethanol production next year going forward. So I've adjusted that number down a little bit. Basically, though, we get down to ending stocks of north of 3 billion bushels, stocks to use ratio going up, and average farm price going down. Mainly our story with corn this year, while this pandemic is hurting the ethanol industry, if things can get back up and moving going forward, I think that can recover substantially. But with corn, we just got to look at if we really do plant north 96 to 97 million acres of corn, we're going to be swimming in corn next year. And this is going to be a huge amount of supply to try to sell and get through the system, which is going to drive our average farm prices down. I think the University of Illinois put out some numbers last week where they had their 2020-21 farm price sitting at $335 farm price going forward. So the outlook for corn is just really for the upcoming year is a huge increase in supply due to a lot more planted acres and a little bit better consumption, but not enough to offset how much supply we're going to probably produce. So just kind of looking at December corn futures right now going forward, the December 2020 price, as we've seen, has taken a hit from the pandemic and things, sitting around $350. But also got 19 and 18 up there to show, when we say a $325 to $340 corn average farm price, that's the average. With an average price, it's going to be above and below that. So there, as we've seen in the last few years, there are marketing opportunities that will hopefully present themselves as the year goes forward. We're just now getting planting started across the country. A lot of forecast is still for a wet spring, as we saw last year. So that could help potentially rally prices a little bit to allow you some opportunity to market some grain going forward. So it's just important that you kind of keep an eye on things and consider what you need, kind of know what price you need for corn, and going forward, be watching and take advantage of any opportunities you see. Soybeans, I think soybeans are sitting the best of the three commodities we're starting today. Really, the COVID-19 hasn't really impacted any of the fundamentals on soybeans. Really, the whole talk on soybeans going forward into the next marketing year is the China demand. How much are they going to stick to that phase one trade deal is a really important question. And that's kind of what's hanging over the market. I think there's still a lot of optimism around the trade deal going forward that China will stick to it, but we'll just have to see. So futures right now, they have drugged down as well, just due to recent outbreak. They're actually around 870 right now as of today when I looked. But also same story as corn. There are just keep on your toes for future marketing opportunities. As you can see, the last few years, price uncertainty and variability has been high. The soybean balance sheet. So again, it's the same thing as on the corn balance sheet. We have the 2019, 2020, last month's WASDE, this month's WASDE report, then 2021 USD Outlook Forum, and then kind of my thoughts over here on the end. Exports. So for the 2019-20 marketing year, we're finishing up. Exports were adjusted down this year for the year. This is probably due to slowdown of purchases from China due to the virus outbreak over there. So that's going to bring in a little bit higher ending stocks on the year, or stocks to use ratios bumping up a little bit, and they adjusted average farm price down to 865. So going forward, the Outlook USDA's Outlook Forum said we're going to plant about 85 million acres of soybeans. The USDA Planting Perspective report, remember, was 83.5 million. So they overestimated a little bit from that report. But into their story is an increase in total supply. Total consumption is up. They really think that the phase one trade deal is going to stay in effect. They think China will buy beans, and that's kind of been the consensus. Export at 2 billion bushels. Ending stocks coming down, and this increase in farm price. Going forward now, though, I think, so 83.5 million acres of soybeans. I don't know how much swapping there'll be. I think some folks will swap out of corn over to soybeans. So I pulled the number up just a little bit, 84 million. Bring in those higher ending stocks from the latest report that we know. Total supply, basically even with what the USDA Outlook had, just because I'm bringing in higher ending stocks and a little bit less acres. Total consumption, I just kept the same. I mean, the China exports is still just a big unknown to me. I can't say anyway. I feel like USDA knows that number better than me. So overall, I have a small reduction in ending stocks, not a lot, basically the same stocks to use ratio. But really just everything else being down is going to kind of bring down our average farm price for soybeans this year. So somewhere probably around the 850, 865 range. Again, University of Illinois' numbers last week had this at 860. It's kind of the outlook going forward for soybeans. So cotton is the one crop that we've had that's probably been the most affected by the COVID-19 pandemic. And, you know, once we really sit down and think about it, we can see why. Cotton is such a different crop than our grain crops in that, you know, cotton's not going to food production. Cotton is a semi-durable and industrial input. And what that means is we grow cotton, we send it to be spun into yarn, then that yarn's being made into semi-durable goods such as jeans, home furnishings, items that, you know, people don't need to buy every day. You can put off buying an extra pair of jeans or new home furnishings, new curtains, if you come on some hard times. So anytime we see lost income or lost employment in the overall economy, cotton really takes a hit. You know, the latest unemployment numbers today is something like 10% of the U.S. workforce has lost their jobs since February. So anytime we have a big overall U.S. economy downturn, cotton's going to take a brunt of the impact. And that's just from the decreased consumption of apparel and home furnishings. If people don't have the money to buy these goods, they're not going to purchase these goods. And there's one thing about cotton right now is when all this kicked off, the market wasn't trading fundamentals. I'm still pretty confident in the fundamentals of the cotton market. I thought when I was giving talks in March and January and February, the fundamentals are there to support a 70-cent cotton price. But right now, the market is trading nothing but fear and uncertainty because there is a huge amount of uncertainty around cotton right now. And it all comes back to, cotton is all one huge global supply chain now. 85% of the cotton in the U.S. is exported from the U.S. each year. It's going to Southeast Asia, where it's getting turned into yarn, where it's probably the yarn's getting shipped to other countries around Southeast Asia, where it's getting made into clothing and other things, which is then coming back to the U.S. The ripple effects of this pandemic across the global supply chain is still something that people aren't really sure about. Really, what's in China, what's going on still there. The Southeast Asian countries that, probably haven't been affected as much. They rely heavily on China for goods that go into spinning yarn and stuff. So just a huge amount of uncertainty around cotton is really what's just driving the market right now. So we can look at the balance sheet. It's really not what's being traded right now. Unfortunately, as we could see from the WASD that came out today, April 9th, exports have been adjusted down 1.5 million bales, kind of as we expected, because factories in China had been shut down for months over there on lockdown due to the virus and pandemic. Therefore, that decreased our cotton demand for the year. So that's still 15 million bales is pretty good export numbers there. But what that has done is increasing our stocks we're bringing over into next year. They also reduced the average farm price for the ending this market year to 59 cents over 60. So going forward into next year, the 13.7 million acres of cotton, I think, is pretty high number that the USDA came out with their Prospective Plantings report this year. I don't really see, especially under the current market conditions, being able to support that many acres of cotton. So I'm sticking my number at 12, a little less than the outlook for them. Total supply, 25 million bales. We're bringing in more from last year now. Exports, I adjusted down just a little bit, about 500,000 bales. Because, there's still just a large uncertainty around that global supply chain of really what's going to happen with cotton going forward. Ending stocks up, stocks to use ratio up, average farm price probably in that 55 to 60 cent range. It'll be kind of surprising. I think 60 cents will be if we can get back to 60 cents, that's going to be pretty remarkable with the cotton market right now. So kind of just looking at our cotton futures, like, is there any marketing opportunities out there right now for our cotton? Sitting around 55 cents right now. As of today, my line here for 2020 is a little old. So kind of what can you be considering right now on the cotton side? So with the future sitting this low, really your price floor is already in place through the Federal Cotton Loan Program. The Federal Cotton Loan Program has a loan rate of 52 cents. And so that 52-cent loan rate kicks into effect whenever what we call the adjusted world price is below 52 cents. And currently that price is hanging around 46 cents. So there's a positive payment coming out of the loan program right now. And so with December futures sitting around 55 cents, and we already have this 52-cent price floor down there, there's really just not a lot of incentive to try to set your own price floor using any type of option strategy or anything right now. It's just, I don't think it makes a lot of, the price floor is there at 52 cents. And it's just, that's probably the best you'd ever get back to with any type of strategy. If you plant cotton this year, really going forward, your benefit from price increase comes with owning the physical cotton. So there's been some talk, so I've seen suggestions for buying calls or something like that. But really, you're just going to hedge that cotton's going to go up by actually planting cotton and growing cotton this year and kind of fall back on that 52-cent price floor, which is what I would say going forward. So we talk national prices. So these are kind of my 2020 marketing year forecast average prices for the three commodities. 325, 340 corn, 860 beans. This is for 2021. 55 to 60 cent cotton. If you kind of want to try to look more Mississippi focused, we're lucky in Mississippi that our annual average price is usually above whatever the market the national price is on the grains. So historically, over the last 2 or 3 years, we've been about 30 cents over, and for soybeans, we've been about 40 cents over. So that would put us some price forecasts for Mississippi, potentially at 350, 370 corn, 905 beans. I think that's probably a little high on the beans, and we've been about 4 cents over on average on cotton, so 59 to 65 cents going forward. So kind of just conclusions, wrap things up. Cotton unchanged to smaller crop this year, increased stocks, much lower prices, and really uncertainty around cotton is how long is it going to take the economy to recover? How fast will we be able to get the economy back up and open and running, and therefore let people be able to purchase goods that are made out of cotton? Soybeans, larger crop, stocks flat probably to up a little bit, lower prices, and really our price support with soybeans is depending on that phase one deal with China and those exports materializing. Corn, much larger stock, much larger crop, stocks up big, and much lower prices going forward. So now I'm going to turn it over to Dr. Johnson, who's going to kind of discuss some farm management strategies you can be doing and other things going forward. So,
thank you, Will. You know, when we get a shock to the system like we've had recently, it's a good idea to go back and review some of the management options that we have, especially since we've been experiencing some financial stress in the ag sector for several years now. Some of the tactics that we're going to talk about, producers have already been working on, and some tactics they wouldn't normally consider, and I certainly wouldn't recommend in a good to normal year, but these tactics might have a place this year just to help folks survive till prices turn around. I want to talk about managing income and cash flows and managing liabilities. The first thing on managing cash flows is always controlling costs. Producers have been controlling costs for a long time now, and so I don't know if there's a whole lot more gain we can get here. A couple of things I've looked at on fertilizer costs are down about 20% from 2019. This may help producers that have not yet been able to get the fertilizer out because of wet field conditions so far this year. And watching natural gas prices, if natural gas prices follow crude oil prices down, there's a chance then that nitrogen prices next year will be more inexpensive even than they are now. So, but those are things we need to watch and see how that plays out. Fuel prices, diesel's down about 50 cents over last year. Interest rates on operating loans around 6 or 6.5%. Right now, it's uncertain how operating loan interest rates are going to be affected by the change in interest rates from the Fed. But again, we'll be watching those to see how that plays out. Another tactic that can be used is to renegotiate cash rents. This might be a good time to talk to landowners about cash rents and maybe consider flexible rents, flexible leases. To reduce capital spending, again, depending on what your situation is, it might be a good year to repair that piece of equipment one more time rather than invest in new equipment, new machinery at this point. And then always, if there's an opportunity to increase your non-farm income, either through off-farm job or other areas, for instance, adding a value-added enterprise. Now, managing liabilities, again, great time to sit down with your lender. Some things to talk about are extending terms on existing liabilities, re-amortize some carryover, or possibly pay interest only for a short period of time until we get prices back up. To reduce debt through funds from non-farm earnings, from outside capital, from other investors, or from sale of farm assets. And this is also a real good time because we know mortgage rates are lower now. This might be a good time to refinance long-term debt like farm mortgages. So those are just a few of the key items that we look at anytime we're trying to manage through a financial stressful situation. Be an awful good time to sit down and see if these things will work for you now. Thanks, Will.
Okay. Let me talk about the policy situation a little bit. And there are a lot of unknowns still out there for us. And we will take a look at a few of these things right now. What we see from the major coronavirus legislation that came through that provided money for a lot of different things in our economy to try to dampen the decline that we've seen in terms of employment, in terms of keeping some liquidity in our markets and so forth. Specifically, there's two pots of money that were targeted to USDA, $14 billion to replenish the CCC funds. The Commodity Credit Corporation is the source of funding for many of the farm support programs, and those programs can't be paid if there's not money in the CCC accounts. So there's $14 billion there. I'll talk more about that in a second. There's also $9.5 billion to support agricultural producers impacted by the coronavirus outbreak. And so that will be a very dynamic conversation in the next few months and few weeks in particular. I'll talk more about it as well, but I do want to mention that there's some other provisions in that legislation that will affect some farmers that, and they're not areas that we normally think of, but there is a Paycheck Protection Program loans. These can be either loans or grants to cover employees and certain other costs. So we've seen a lot of farmers that are looking into this of late. These are programs that are probably going to run out of funding. What I read from Capitol Hill today suggests that there is discussion about replenishing these funds, but they're expecting the demand for these funds to exceed the amount allocated. So, Will, if you'll turn to the next slide, let me talk a little more specific about the CCC funds. What's really going to happen there is that the Congressional Budget Office has estimated that the CCC was about to spend 2.96 of the $30 billion for fiscal year 2020. So they were about to hit the limit of what was available in that program. What they did was provide $14 billion that is going to pay off some of the estimated program costs for existing programs, which would then provide some slack in the CCC accounts. So it would cover the 2019 MFP payments, estimated to be $9.7 billion, estimated ARC PLC payments for the 2018 crop that'll be made in October, that were made in October of 2019, and some CRP rental payments. So this is really just to cover some previous expenses that were largely well known, so that the CCC stocks would have a little bit of slack. So that's what that money is going to do. And the big question will be, what with the added slack in the CCC accounts, what will that be spent on? I'll talk more about that in a moment. It also talks, and this is what a lot of the talk in Washington, D.C. is about right now. There is some language, and I've quoted it here, but it's $9.5 billion to help support agricultural producers impacted by coronavirus, including specialty crops, local food systems, farmers markets, restaurants, schools, livestock, and dairy producers. There's a lot of discussion about who is going to be able to tap into these funds. Read a story this morning that suggests that the various commodity groups that have approached the Secretary of Agriculture have already requested amounts for their particular commodity group that far exceed the 9.5 billion. So we will, and I've also had discussions with people that say that this list that you see here, the commodities that are specifically called out, does not necessarily mean that they're the only commodities that are going to get a portion of these funds. This will be a big political battle. The Secretary of Agriculture is going to be in the crosshairs as there is a push for him to get these funds out the door, but there'll be a lot of political haggling about how these are allocated. So moving on, one of the things that I thought I'd take a look at is, given what has occurred here in Mississippi, what's happened to the prices for the crop insurance program, our expectations today versus where they were when the price guarantee was set on crop insurance. Right now, the price guarantee for cotton crop insurance this spring was 70 cents. Corn, it was $3.95. Beans were at $9.31, and rice at 12.1 cents. You see that rice price at the futures market have not changed much. Soybean prices are down 7%, corn down 11%, and cotton down 22%. What this means is that increases the chances that if you had revenue insurance, which most producers purchase, that the cotton looks like it is nearly in the money if you had a fairly high coverage level already. And it's just going to mean that a smaller yield decline will be enough to trigger these crop insurance programs. Going on to the traditional farm programs, let me talk about the PLC program and the reference prices. Remember, for corn, pay attention to the 370 mark if producers chose to go into the PLC program. That's the point of reference for triggering a corn payment. For rice, it's 14 cents. Soybeans, it's $8.40. And we're talking about looking at some national average prices. That corn is looking increasingly like it will be in the money on PLC for 2020. Soybeans were already looking that way. And we've got rice is quite likely to be there as well. With the seed cotton program and the combination of lint and cottonseed prices there, the target is 30.64 cents on seed cotton. Will did a calculation this morning, and we're looking at the seed cotton program is very much likely to be in the money for 2020. It's also for the given the changes that was made in the WASDE report today, the seed cotton program payments are looking for the 2019 crop, which will be paid in 2020, are looking like they've jumped up a little bit and may be in somewhere around the 7 cent range. Let's go to the last slide here, Will. A big question is whether there'll be a new round of commodity program payments like the MFP payments for the last few years. There is some expectation that might occur out of the additional CCC funds. But remember, the crop insurance and the Title I programs like PLC are going to have to come out of those funds as well. Another question is, there is potentially likely to be a phase 4 of the coronavirus legislation. Whether there will be additional agricultural funding in that legislation is an unknown at this point. There are people talking about it. I don't have a good sense of what the odds are of this happening, but this will be a point as you watch the news on the ag sector. I think these are both points that are to be cognizant of, that they might happen. I also would say that it would be not very prudent to count on these payments right now because we simply don't know where these negotiations are going to take us. And kind of one last point that I will make, Will alluded to this, and I think Jeff as well. Economists that we talk to around the country, the big unknown right now, if the virus subsides and we restart the economy, there is really, this is a rather unprecedented situation, and the speed at which the economy rebounds is a really important question. And so one of the things we'll be watching is, will we see unemployment numbers turn around? Will we see the stock market rebound and things like that? But one of the things I think in the ag sector that we have to realize is that this has had a worldwide impact. There's not a major economy in the world that has not been hit. So when it comes to our export demand for our markets, we're still in a situation where who's going to buy our agricultural products when their economy just took a downturn? And that's another thing that we'll be watching kind of from the macroeconomic standpoint. So, Will, I will stop there. And I guess we can open it up for questions.
Right. Thank you, Keith. Before we jump out of this to the questions, this here is our contact information. Feel free to call us anytime. We also have Brian Mills, who wasn't able to join us today. He's our row crop economist that's stationed out of DREC in Stoneville, who is also a good source of any information you might ever need as well. So looking in the chat, doesn't appear we have any questions as of the moment. I did receive one question through email beforehand that asked about, how long can we expect this pandemic how long will the effect be? And I think Keith kind of answered that in his closing remarks there. That's a big unknown, is how fast this economy can get up and running again. And going forward, what can we do? And then also as part of that question, the question included, what are some marketing strategies that producers could be doing right now? And really the answer to that is, we're kind of on the downswing of a market movement right now. So, we wanted our marketing strategies in place before this hit in retrospect. But, always just be considering the marketing strategies that are out there. Know what your price points are that you need to be making and have a plan in place going forward from now to try to reach those points. And if there's anything specific to your operation that you would ever like to talk about concerning that, feel free to give me a call anytime. And with that, Jeff or Keith, do y'all have anything else y'all would like to add?
One thing, given the low, and I'm going to kind of pose this as a question to the two of you, given that we're at some extraordinarily low fuel prices right now, is there an opportunity for farmers to try to lock in fuel prices as far out as they can go?
I think short term, just make sure your fuel tanks, your storage tanks are full, your on-farm storage tanks are full. But for a long term, that's probably a marketing question. See if Will may want to address, opportunities on the fuel futures opportunities.
So I haven't really looked at fuel futures anytime soon, but I would say that as far as Keith's question, if an opportunity presents presents itself to lock in some of these low prices we're seeing, I would think now would be the time to do it going forward because they're low.
Well, and part of the reason they're low is because of the battle going on in other oil producing countries. So, in addition to a slack economy, you've got the Middle East and Russia and some others that are in a bit of the price war. So this may be an extraordinarily low fuel price season.
Exactly. With that, all right, we have one question here. I'll read out. Are y'all hearing any problems with operators bringing in H-2A workers yet in the state? I talked to a friend in California and things are running well because many were in place where he works. Unknown about what might come as Washington State begins to bring those workers in next month. That's a good question. I mean, I haven't heard anything specifically yet either, but that, as far as I know, that is a concern, being able to bring in farm labor this year. I don't know if Jeff or Keith, have y'all heard anything in Mississippi specific yet, or?
I haven't had any problems at all yet.
Okay. But yes, that is one thing we didn't mention, going forward as the planting season goes, is that issue of labor and, being able to get your crop in the ground from labor concerns, and also, just some supply disruptions going forward in your planting. Are you going to get your seed and fuel delivered and stuff and fertilizer just due to the issues of people not being able to move around and reduce opportunities? It is one concern that I know a lot of people have just during planting season as it's getting ramped up.
Well, one comment that I'll make, and I know people are bringing in H-2A workers for a particular reason, and they have particular skills. But we're in a situation where the unemployment rate has suddenly spiked. There are a lot of unemployed people in the United States that weren't unemployed 2 months ago, and B, there are probably going to be government programs to incentivize you to hire people. So we're in this unusual situation. I don't know if that's going to work for any farmers, but there's going to be a lot of incentives out there to hire people and put them on payroll.
And that's a very good point. With that, that's the only question we've had. Jeff, do you have anything you'd like to add? Anything?
I don't, not this time.
Oh, all right. We've got another question that's popped in. But right now, there's a disincentive for people who were laid off to work between what they're getting in unemployment plus the COVID-19 payments. They're making more on unemployment than potentially working. That is probably a good point to make as well, is, we have really ramped up our unemployment benefits during this time. That short-term work might be disincentivized. Any thoughts, Keith? Or?
No, we're doing the catch-all bill that we wrote has so many different dimensions to it that you've got some things that are conflicting with one another. The payroll loan or grant that is available to employers. Yes, you're going to have to compete with people who are getting unemployment benefits. And so that's going to be a bit of a tension in this legislation.
Yes. But also isn't in the legislation, aren't there quite a few groups that kind of fell through the cracks in this legislation that would potentially still out there?
Well, I think there's when you write legislation that fast and that big a ticket, that it's Yeah, assuredly, there's things that got written poorly or got left out, and I think pragmatically, what we're going to see is that you have a Republican-controlled Senate and a Democratic-controlled House. Their priorities of what's in the next bill, if there is one, are going to be quite different. So there's going to be, I suspect there's going to be some significant haggling on further help. But I think we all just are aware that this is an election year, and there's going to be a lot of political people who are looking to show that they have done something. And so I think it may take a while, but there are likely to be some additional funds put out.
Okay. That's good. Well, I think that might be all the questions we have, and we're running towards the end of our meeting time here. So is there Jeff or Keith, y'all got any final comments y'all'd like to say or anything?
Thank you. And if folks have questions for us, please feel free to contact us.
For sure. I'll put our contact information back up here on the screen to kind of end up. And as Keith said, if you ever have any questions or anything, feel free to call us. If there's anything we talked about today you'd like to talk about more in depth, we're available anytime. So, well, thank you for joining us today.